Welcome to This Explainer. Look, if you've ever just sat there staring at a stock ticker, watching that price flicker every single second, up a few cents, down a few cents, on, you've probably wondered what's actually happening, right? You might assume there's a bunch of Wall Street big shots in fancy suits setting those prices behind closed doors. Actually, scratch that. That is not how it works at all. Today, we're going to embark on a journey from the absolute second-by-second mechanical chaos of the market all the way down to the foundational math that determines what a company is actually worth. Get ready, because by the end of this, you're going to see those flickering numbers in a completely different light. We're essentially using a peeling the onion framework today. Here is our agenda. 1. The order book engine. 2. What is intrinsic value? 3. Calculating a stock's worth. 4. Comparing valuation methods. 5. Step-by-step value review. And 6. When markets ignore value. We're moving from the fast-paced mechanics of price flickering straight to the concrete tools for determining actual value. Okay, let's dive into this. Section 1. The order book engine. To understand value, we first have to understand price. This is the market's secret playbook, the order book. This is the true mechanical engine driving literally every single price movement you see. At its core, the stock market is just a massive, chaotic marketplace. And the order book? It's a live, constantly updating list. On one side, you have the bids. This is exactly what buyers are willing to pay. On the other side, you have the asks, the prices sellers are actually willing to accept. When you see a stock price on an app, it's usually just the last transaction that happened. But the real heartbeat? That's the bids and asks actively battling it out, right there in the order book. There is this constant tug of war going on between these two sides. Think of it exactly like a giant auction house. When buyers get hyped, maybe there's some killer news about a company, they get aggressive. They start throwing out higher bids, basically begging sellers to hand over their shares. That bidding frenzy pushes the price up. But let's look at the other side. When sellers get scared, they want out immediately. They start lowering their asks to find anyone willing to buy, creating a massive big sale where everyone just offers a cheaper price to get out fast. The gap between those bids and asks is exactly what creates that extreme price volatility. This mechanical battle is why the price flashes green and red all day long. Section 2. What is intrinsic value? So the order book sets the price second by second. But who decides what a stock is actually worth in the grand scheme of things? That requires us to look a lot deeper, which brings us to intrinsic value. Warren Buffett famously put it like this: investing is like buying a farm. You look at its soil and crops, not what the neighbor paid yesterday. This is the absolute core philosophy of value investing. Intrinsic value is the foundational, real worth of a company based strictly on its fundamentals, its earnings, its assets, its growth potential. It is what the company should be worth if you completely ignore all the hype, the panic, and that chaotic auction house we just talked about. But here is a genuinely crucial disclaimer that we always need to keep in mind: intrinsic value is highly subjective. It's just an estimate. It is not like weighing a bag of apples on a scale where absolutely everyone gets the exact same undeniable result. Instead, calculating intrinsic value is much more like trying to guess how much those apples will sell for next year. Different people can look at the exact same company and come up with entirely different numbers based on their own guesses about the future. Section 3. Calculating a stock's worth. So how do we actually make those guesses? Let's transition to the actual math and look at the different angles smart investors use to calculate a company's true worth. One of the most common ways is called discounted cash flow, or DCF. Here are the steps. First, you predict the future money, the cash profit, a company will make. Let's imagine a company that generates $100 a year for the next 3 years. Second, you discount that back to today's dollars, because future money is worth less due to things like inflation. Using a 10% discount rate, those $100 cash flows are worth about $91, $83, and $75 today. Third, you add a terminal value, which estimates what the company is worth after that 3-year forecast. Let's just say that's $1,000, which discounts back to about $751 today. Finally, you add all those up, which gives us around $1,000 total, and divide by the total number of shares. And this brilliantly illustrates the whole concept. If the total discounted value of the company is $1,000 and there are 100 shares in existence, our intrinsic value is simply $10 per share. Now we have a benchmark. If you look at the stock market and this company's trading at $8, it might be a fantastic undervalued deal. But if that chaotic order book has pushed the price up to $12, it's potentially overvalued, and you might want to wait. Section 4. Comparing valuation methods. Discounted cash flow is really just one tool in the toolbox. No single method is perfect, so investors absolutely must pick the valuation model that fits the specific type of company they are analyzing. Let's weigh the pros and cons of the major strategies. We just covered DCF. Its huge pro is that it gives an incredibly detailed view of the future, but its con is that it is quite complex. Then we have the dividend discount model, which is great for estimating reliable income, but it completely ignores non-dividend growth. Next up is asset-based valuation. This one is fascinating because it's purely physical. You just add up physical stuff like buildings and equipment and subtract the debt. It's totally grounded in reality, but its con is that it completely ignores future earnings. Finally, we have earnings multiples, like the PE ratio. The massive pro here is that it's quick, but the con is that it heavily relies on peer comparisons, which can sometimes be completely inaccurate. To make this concrete, imagine a reliable utility company that provides electricity. They pay steady, predictable dividends. So you might evaluate them using the dividend model, based entirely on their reliable $2 per share payout. Now compare that to a high-growth tech stock. They might not pay any dividends at all. For them, investors might quickly use an earnings multiple, saying, well, similar tech companies trade at 20 times their earnings, so we'll just apply that multiple here. You've got to match the tool to the job. Section 5, Step-by-Step Value Review. Now it's time to turn all these theoretical models into a practical, actionable checklist. How do you actually identify a stock's potential? The absolutely crucial point is following this step-by-step review process. First, calculate your estimated intrinsic value using the method that best fits the company. Second, compare that exact number to the current market price. Here's the golden rule. If the market price is less than your intrinsic value, it's potentially undervalued, a really good deal, like buying $1 for 80 cents. If the market price is greater than your intrinsic value, it's potentially overvalued, signaling you should probably wait or sell. But always acknowledge the final step. These are subjective risks and estimates. Your growth rate guesses could simply be wrong. Let's move to and see how this builds into our final section. Section 6, When Markets Ignore Value. Because as great as math is, sometimes the real world completely ignores it. Market excitement often completely overrides fundamental math. Think about Tesla a few years ago. If you looked purely at their earnings and assets using our strict intrinsic value models, the stock price seemed wildly unreasonably high. But the order book was still flashing green. Why? Because investors were buying based on future expected growth and new technology, not today's profits. Market sentiment, the hype, and the belief in a massive future breakthrough can easily push a stock to trade way above its calculated intrinsic worth. And we really can't ignore how past market trends influence these valuations. External factors play a massive role. In 2020, we entered an era of incredibly low interest rates. What does that do? It makes stocks look vastly more attractive than safe bonds. This directly fueled the immense market hype we saw in 2021, where tech and growth stocks absolutely surged. Prices skyrocketed regardless of calculated intrinsic value. Then, as external factors shifted in 2022, market sentiment cooled and reality started to set back in. The environment matters just as much as the math. Which leaves us with this final, provocative question: how long can the market stay irrational? We've learned today that while the order book drives the second-by-second price, intrinsic valuation gives you the mathematical anchor of what a company is really worth. It is a phenomenal tool to find underpriced gems. But always remember, the market is made up of human beings driven by fear and greed. It can ignore your perfectly calculated intrinsic value for years, staying irrational much longer than you might ever expect. So keep learning, keep analyzing, and never stop questioning the numbers on your screen. Thank you so much for joining me on this explainer, and I will see you next time.